Afternoon from San Diego. This is Peter Quinn with Kidder Mathews. I've got with me here today Senior Vice President, Head of Capital Markets for Kidder Mathews for the Southern California region, Jamie Dick. Jamie is going to give us an update on interest rates, the market, direction, employment, your life with finance. How are you, Jamie?
Good afternoon, good morning, everyone. Basically, it's the capital markets right now are very much in flux. Everyone, of course, has been following the Fed and whether or not they were going to lower rates. They did. And to the uninitiated, the shocking uh, result was long-term interest rates, 10-year Treasury as an example, actually went up, not down. And there's a little for those of us who've been doing this for a while, that was expected. And then today we had an additional event happen that has caused interest rates to go further up.
What happened?
Since the well, initially, just to make a comment, when the Fed lowers their rates, it affects the short-term part of interest rates, and that's a positive if you are borrowing from banks and credit unions because that's how they establish their cost of funds. So we saw an immediate reduction in quoted rates from banks and credit unions after the Fed lowered their rate. Conversely, however, life insurance companies, CMBS lenders, they price off of 10-year treasuries, and those run independent of the Fed. And in fact, by the Fed lowering their rate, that's viewed as inflationary. And so the 10-year treasury actually went up the day that the Fed lowered their rates. And that's not unusual. That happens always. Today, what happened was an unexpected, more significantly more positive report on jobs and job creation. We had 245,000 jobs created in September, which was much more than they expected. And in fact, unemployment nationally went down. And so and that caused the 10-year Treasury itself to go up 13 basis points, which is not insignificant. So in one day. And in fact, it's approaching 4%. And to give you an idea of what that means, since the Fed lowered their rate, the day they lowered the rate, the 10-year started off at 365, and we're now almost 35 basis points higher for life insurance loans, CMBS Wall Street loans. Now, having said that, these are all kind of daily fluctuations in the market based on world events, you know, wars, people bombing people, oil production being taken offline, et cetera. But the expectation is over the next, between now and the end of the year and into the first quarter next year, both short and long-term rates will continue to trend down. And
In summary,
but
we're in a transitional period in the marketplaces, things that are happening in the world, which is what always happens in situations like this, are having both predictable and in some cases unpredictable effects on the overall market. We're months away from the sort of stable market that you can borrow and lend in with surety. Agree?
right, I completely agree. My advice to borrowers is always it never really changes. I always think trying to play the market relative as to when you should lock your rate on your loan is a fool's game. It's, that's crystal ball looking, and my crystal ball, after 45 years of doing this, is still rather fuzzy. So I tell my clients when you have the opportunity to lock a rate, first of all, first thing you want to do is get to the point where you actually can pull the trigger. You've gone through the whole process of figuring out, you know, all the processing that goes with getting a loan from a lender. When you get to the point where you can lock a rate, take a look at the rate, take a look at what your expectation is, business plan on the purchase or the refinance, and if the rate works, lock it. If you sit there and start saying, well, rates may go down tomorrow or the next day or next week, or if such and such wins the election, they'll go down. If the other person, they'll go up. That's just, you're just asking for trouble. And the other way I like to say it is, I tell people just remember the expression is buy low, sell high. It's not buy lowest, sell highest, and trying to hit that magic number. So
you can't catch a falling knife or capture a market situation that is predictable, and often it's unrewarding. Everybody, this has been Jamie Dick, Senior Vice President of Kidder Mathews Capital Markets, here with me in San Diego. And this is Peter Quinn, Kidder Mathews. Take care.